In today's episode, we'll break down two important stories. First, we'll talk about the OYO IPO, and then we'll talk about the economics of ship breaking in India. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Tuesday, 21st July. Coming to the first story. So you've probably already heard that Oravel, the company behind OYO, is gearing up for an IPO. This is the company's third attempt at going public. It first flirted with the idea back in 2021 when it was reportedly looking for a valuation of $12 billion. It pulled back then only to file a new offer document in 2023, and it's trying yet again. But this time, its offer documents talk of a different looking business. Now, one hint of that shift comes from its name itself. In the previous avatar, the company rested heavily on the OYO brand. But last September, it rebranded itself as Prism after the software that runs its hotels. The choice was meant to reflect a new reality. The company had pivoted to running a diversified ecosystem of brands under its umbrella, and OYO was now just one brand among many. 9 months hence, the company has made a new set of filings to go public, and this time it wants to pick up Rs 6,650 crore entirely from selling new shares. Neither its founder Ritesh Agarwal nor SoftBank, its largest shareholder, is selling any shares. So how investable is Oravel now in its third attempt? For that, it's worth looking at the business it has now morphed into and what dreams it's chasing. So Oravel's investment pitch rests on the incredible potential of the market it's in. So the world's hospitality industry is worth roughly $1.3 trillion. Most of that is broken and unorganized, made of independent, unbranded properties which run without a technological backbone or a way to reach customers. And this is true of India, where 92% of hotel storefronts are unorganized. It's also true of advanced markets like Europe, where 77% are in the same boat. So Oravel wants to become the software and distribution layer to this massive market. Any small hotel can sign up and list on its service, and within half an hour, the listing shall be up on the OYO app as well as 230 odd other travel sites. Oravel will handle check-ins, keys and payouts, all for a share of the booking amount. So Oravel promises a large base of direct demand for anyone who signs on. Around 7 in every 10 bookings come to the company through its channels, and they save the 15 to 20% commissions other sites charge on each of those. The company boasts a high number of returning customers and a loyalty program with 16.64 million members in India. Now, till recently, most of its offerings were limited to budget Indian hotels. And then it began to expand its footprint. So it captured a foothold in the United States by acquiring G6 Hospitality, which ran the Motel 6 chain, and it also picked up vacation home brands in Europe. More than 80% of revenue now comes from outside India, but most of its staff still sits in India and is paid Indian salaries. This is the dream. And for the first time, it can back the dream with earnings as well. Oravel's operating profit has gone from Rs 274 crore 2 years ago to nearly Rs 2,000 crore in the latest 9 months as its bookings have doubled. But can its business really match its ambitions the way it currently stands? So looked up close, Oravel barely seems like a single business. On the surface, Oravel claims to operate nearly 3 lakh storefronts across 35 countries. But few of those resemble what you think of when you hear OYO Hotel. Just over 24,000 of those storefronts, or around 8%, are hotels. In contrast, it runs almost 1.25 lakh homes, most of which are vacation homes in Europe, managed by firms like Bell Villa and Dan Center. It also has over 1.44 lakh third-party listings, all of whom pay it a flat fee to sit on its platform. Based on offerings alone, Oravel is partly a hotel booking website and partly a company that manages short-term rentals in Europe with a small hotel arm appended to it. Each business makes money in a different way. So let's start with hotels. The simplest is the classic OYO room you're probably familiar with. Once an independent owner signs up under a brand like OYO, Oravel takes over the pricing and the listing, and from this point, Oravel is the one selling the room. It sets the price, it recognizes everything a guest pays as its own revenue, and later the hotel owner is paid separately. Between April and December last year, it recorded almost Rs 4,300 crore in revenue from this vertical. But this model came with a problem. As long as its hotels were run by others, they would be plagued by quality issues. Rooms would be unclean or wouldn't match the photos uploaded online. They infamously even had privacy issues. Being asset light may have appealed to investors, but it didn't guarantee customer delight. So, to get around this, Oyo began a new vertical: leasing hotels itself or signing management contracts to run them directly. So these were listed under its upscale Sunday, Townhouse, or Clubhouse brands, and its business model here is different. The costs shift from the hotel owner to Oravel's own books. As recently as March 2023, the company just had 4 properties of the type, but by the end of last year, that had ballooned to 1,573 properties, making up almost half of all its Indian bookings. This shift marked a huge change to the costs the company was bearing. In less than 2 years between March 2024 and December 2025, for instance, its lease liabilities went up more than tenfold, from approximately rupees 240 crore to nearly rupees 2,800 crore. And then in December 2024, Oravel added a completely different creature to its P&L statement when it added the American chains Motel 6 and Studio 6 to its portfolio. On paper, they practically doubled the booking values Oravel received overnight. But that didn't translate directly into revenue. After all, while the brands were owned by Oravel, the motels themselves were run by franchisees. So guests would pay them directly. Oravel would only get a royalty for their brand and booking systems, and of the nearly rupees 11,000 crore these rooms received in bookings, Oravel's own revenue was just over rupees 1,000 crore. Now, these are 3 entirely different business models under Oravel's hotels vertical alone. Homes, meanwhile, run on different economics. Like with Oyo Hotels, guests book through Oravel and pay Oravel for their stay. But Oravel must pass most of that through to the homeowner. It only gets a commission and a few add-ons like cleaning fees and cancellation insurance. And of the nearly rupees 3,900 crore this vertical generated between April and December last year, almost rupees 2,900 crore went to homeowners. For listings, on the other hand, Oravel isn't paid by the booking at all. Property owners simply pay Oravel a flat subscription fee to appear on its platform. And even though these listings make up more than half the storefronts the company talks about, they together netted just rupees 144 crore of subscription revenue between April and December 2025. This is what makes Oravel such a complex company to study. Under the hood, there are 5 businesses they run at once. For all this complexity, there's one thing Oravel can now boast of, which it couldn't before. The company has been cash positive for every year since 2023. Between April and December last year, it brought in almost rupees 1,600 crore in cash. But the problem is that most of that cash would drain back out immediately. Take rents. Over those same 9 months, for instance, the company paid out over rupees 400 crore as lease principal and almost rupees 300 crore in addition as lease interest. This was simply the cost of keeping those company-managed hotels in its hands. The company also paid nearly rupees 700 crore in interest payments, and with all those outflows, it could barely hold on to rupees 215 crore in cash. This interest in particular has been bogging the company's books down. Consider this. The company has been making operating profits before you consider interest and tax since March 2024 at rupees 1,080 crore. But the burden of its interest has constantly pushed it into the red. In FY 2024, it saw a pre-tax loss of rupees 184 crore, and the next year, its pre-tax loss had grown to rupees 334 crore. It's only between April and December last year that, for the first time, the company finally saw a pre-tax profit of rupees 230 crore. But a generous portion of that, rupees 225 crore, came from other income rather than running hotels. This is perhaps one of the major reasons the company even wants to go for a public issue. 3/4 of the rupees 6,650 crore it plans to raise, or nearly rupees 5,000 crore, shall go into repaying its dollar debt. But even that wouldn't eliminate the debt load. Even with all that fresh IPO money going to lenders, the company will be left with roughly rupees 3,000 crore in borrowings. And that'll keep adding the drag of interest to its books. So the challenge for Oravel is to make enough profit once its debt load becomes manageable that it can keep the company growing fast enough to justify its valuation. Now let's return to the investment pitch we began with, that there were hotels scattered all across the world and all the company had to do was bring them under its own platform. Perhaps that was the vision the company once started with, but that vision was beginning to blur well before this IPO. In fact, even as far back as 2024, the company's revenue from hotels was beginning to fall. The company's own channels, which is the YoYo app and website, corporate channels, partnerships, etc., have been bringing in a steadily smaller share of bookings. And this direct demand has fallen from over 72% 2 years ago to under 68% last year. This is despite the fact that the company spent over rupees 1,150 crore in marketing alone between April and December last year. It seemed the original OYO promise had created a company that was struggling and perpetually in debt. Perhaps this is why the company felt the need to create a constellation of brands for itself. In India, the company began buying more control, even at the cost of lease liabilities. Abroad, it began assembling new properties, acquiring a franchise network in America, servicing vacation homes in Europe, but these are heavily contested markets and the share is small. It currently holds under 1% of Europe's homes market and about 1.8% of the hotels in the markets it competes in. If it does well, this is a massive runway ahead, but it's nowhere near being dominant anywhere it does business. In fact, many of its Western businesses aren't even booked through its platform. For more than 6 in 10 nights, its European rooms are booked through other travel websites. Now, this doesn't resemble the picture Oravel wants you to see of a technology platform turning into an entry point to a massive, broken hospitality industry. This is not India's answer to Airbnb. For all that, Oravel is maturing as a business, and it's finally chasing profits instead of a thesis. As its reward, it's finally breaking even. But what business is it maturing into? Is this still a tech company that touches hotels? Or is it yet another hotel company offering budget stays across a few geographies? That's the question this IPO forces you to answer. If you prefer reading the daily brief instead of watching the video, check out the link to the newsletter in the description. Coming to the second story. In May, India's shipping ministry issued the world's first ship-breaking credit note to Bella Shipping India Private Limited, which recycled a bulk ship carrier at an Indian yard. The note was worth Rs 29.81 crore, valid for 3 years and freely tradable. Once the scrapping is complete, they receive a credit note equal to 40% of the vessel's fair scrap value. And this can only be spent on building a new ship at an Indian shipyard, which has to be registered under the Shipbuilding Financial Assistance Scheme or SFAS. We'll get into the details of what the credit note entails. But what's more fascinating is the process the credit note is established for: ship breaking or ship recycling. That's what our story today is about. See, commercial ships are commonly recycled after roughly 25 to 30 years. After that period, corrosion sets in, machinery starts failing, and repair costs climb to the point where keeping the vessel sailing costs more than it earns. At that point, the owner sells the ship to a recycler who breaks it and sells the pieces. So, like other recyclable objects, ships are bought and sold for scrap by weight. But the difference is that they're weighed in light displacement tonnage or LDT. This measures the ship's own physical mass, its hull, machinery, equipment, and spares. But this metric excludes the fuel, cargo, or crew on board. Roughly 90% of a ship's LDT is steel, which is split into two grades. About 60% is re-rollable, meaning it can be reshaped into new bars and plates without first being melted down. The other 30% is melting grade and goes to furnaces for recasting. And the rest, non-steel 10%, is machinery, cabling, furniture, and fittings, almost all of it resold rather than landfilled. Now, the trade exists for a simple reason. Ship owners like Bella Shipping get one last payout on an asset about to be written off, and recyclers get large volumes of high-grade steel at a fraction of the cost of making it from iron ore. And the International Maritime Organization acknowledges that recycled steel uses roughly 1/3 of the energy required to make steel from raw material. So in India, the ship breaker or the ship breaking plot operator buys the ship outright and owns whatever comes off it. And a plot is simply a part of the beach that the operator takes on lease from the Maritime Board. Some names include Leela Group and Shriram Group. Now, that's clearly a win win situation. But obviously, ships are huge entities and it's difficult to suddenly transport them by any means to a scrapyard. And that in itself is another process that's limited to very specific shipyards that could actually be far away from the origin city. Now, the world's shipbreaking industry is unusually concentrated. In 2025, 80% of global shipbreaking by tonnage was handled by India, Bangladesh, and Turkey. India alone accounted for approximately 35% of the global total. So, in other words, roughly one third of all ship tonnage recycled globally in 2025 was processed at Indian yards. Now, within India, the industry is almost entirely one yard, Alang on Gujarat's Gulf of Kambat coast, which handles about 97% of the country's ship recycling. So the Alang cluster began operating in 1982-83, stretches across approximately 10 kilometers of coastline, and has dismantled more than 8,800 ships since its inception. It has 150 plots of land to host old ships, of which 128 are operational. Its main global peers are Chittagong in Bangladesh, Kadani in Pakistan, and Aliağa in Turkey. So, why is the shipbreaking industry clustered just in a handful of coastal towns in Asia? One reason is economic. Shipbreaking is labor intensive rather than capital intensive. So, Alang uses a shipbreaking method called beaching, in which at a suitable high tide, the vessel is maneuvered, sometimes with tug assistance, to a gently sloping beach and grounded close to the recycling plot. As the tide recedes, workers begin dismantling the whole ship section by section, and that needs a lot of cheap labor in a beach town along with adequate shipping infrastructure. Not many places can provide all three conditions. Now, the second reason is regulatory, with developed countries having tightened environmental rules over the decades. An old ship can often be packed with hazardous materials such as asbestos in the insulation, oil in the tanks, and toxic paint on the hull. Handling all of that to meet Western environmental standards is expensive, and Western companies eventually stopped doing it because they couldn't make money out of it. And because of this, the work moved eastward, where cheaper labor was available and environmental rules were looser at the time. India has since tightened its own rules regarding shipbreaking, but the migration had already happened. And even then, our rules are less strict than what Europe imposes on its own recyclers. So the scrap steel from Alang is transported roughly 50 km inland to Bhavnagar, which has grown into a steel processing town around the yard. The town contains more than 60 induction furnaces and 80 re-rolling mills, and when India passed the Recycling of Ships Act in 2019, the government said ship recycling could meet about 10% of India's secondary steel needs. Now, the re-rollable steel has two possible destinations. It can either be melted down and recast into fresh steel, or it can be reheated and reshaped directly into construction rebar without a full melt. Rebar is a finished, higher value product that, with a few more steps, can be ready to use in buildings, so the second route pays more per ton. But the construction industry itself wasn't ready for it. For years, most re-rollable steel from ships ended up in the melting route. Now, Indian building rules didn't allow ship-derived steel in construction rebar, because rebar has to meet strict strength standards. Even if it did, construction players needed to verify where a ship's steel came from or how it was originally made, and they couldn't do that. In the absence of any buyer for rebar made from scrap, re-rolling mills only resorted to melting. So in January 2026, there were reports that the center was planning to relax these norms. And this would allow ship-derived steel to qualify for re-rollable bars based on its composition, quality, and strength tests rather than where it comes from. If this is implemented, it could raise the price that Alang's recyclers receive for the steel. Now, beyond steel, everything else off the ship moves through a chain of buyers. As workers strip items down, the shipbreaker sells them in bulk to dealers. Some buy entire cabin contents, others deal in engines, mechanical parts, or electrical fittings, and the dealers then hold silent auctions where local shopkeepers write down what they'll pay and the highest bidder takes the lot. Those shops line roughly 10 kilometers of road running inland from Alang, and anyone can walk in and buy anything from tea sets to mattresses to ice cream machines and lifeboats. The whole ecosystem employs about 15,000 workers directly and supports another 150,000 in ancillary businesses. So for years, Alang has been operating at a fraction of what it was built to handle. In 2011-12, the yard dismantled a record 415 ships in a single year. Now FY25 saw only 113, its lowest in over a decade, before a marginal recovery to 119 in FY26. But this is not because of a single reason. There have been several overlapping shocks that have pointed in the same direction, keeping old ships in service rather than scrapping them. For one, the Red Sea, which is a popular shipping route, has been disrupted since 2023 because of attacks from the Houthis, who are backed by Iran. So, most large carriers had to divert around the Cape of Good Hope in South Africa, which added nearly 2 weeks of travel to ships on Asia Europe voyages. Container shipping, which dominates the route, felt the brunt of this the most. Since a ship now completes fewer round trips per year, carriers had to keep older vessels in service to move the same volume of cargo. In the first 7 months of 2025, only 5 container ships were sent for recycling worldwide, a fraction of the usual rate. Now, the second reason is a factor that loves playing spoilsport for shipping: geopolitics. The US and EU have banned imports of Russian, Iranian, and Venezuelan oil, and to keep exporting anywhere, those countries move their oil on old tankers whose real ownership is hidden. This shadow fleet consists of nearly 1,000 tankers that have been used since 2021, most of which are older than the global fleet average and would otherwise have been scrapped. And there's a currency problem too. Alang shipbreakers buy old ships in US dollars but sell the recycled steel in rupees. So when the rupee weakens against the dollar, the ship costs more to buy while the steel earns the same or less. And that, of course, had become an acute problem earlier in the year with the rupee's depreciation. So India has done 2 things to try to fix this. The first is the credit note scheme itself, meant to make scrapping in India more attractive. Once recycling is complete, the vessel owner receives a transferable credit note equal to 40% of the vessel's fair scrap value. And this can partly be redeemed against a new vessel ordered from an Indian shipyard. Now, the second is Hong Kong Convention compliance, which is the universal standard for ship scrapping. Now, India passed the Recycling of Ships Act in 2019 to align its domestic law with this treaty. So, as part of compliance, each Alang yard reportedly invested between $560,000 and $1.2 million, or rupees 5 to 12 crore, to meet its environmental and safety standards. That premium is what Indian yards are betting will attract ship owners who face growing pressure to scrap only at compliant facilities. So here's the bottom line. The bet behind both the credit note and the compliance push is that a wave of scrapping is coming. BIMCO estimates that as many as 16,000 ships could be recycled globally over the next 10 years, which is about twice the number recycled during the previous decade. If India's compliant yards are ready when that surge arrives, Alang could capture a much bigger share of it than it does now. But the forces that have suppressed volumes over the last few years are still somewhat active. Longer routes, sanction-driven demand for old tonnage, and a weaker rupee. As long as it pays to keep old ships sailing, they'll keep sailing. So India's credit note nudges that, but it doesn't fully rewrite it. What the credit note could do is make sure that when the calculation eventually shifts, Alang is where ship owners bring their tonnage. And perhaps if the demand rises, there is a possibility that the Indian shipbreaking industry expands beyond a single yard. Now coming to the tidbits. India crossed a milestone in green transportation with its first hydrogen-powered train commencing commercial service on July 19, 2026. The train currently operates between Jind Junction and Sonipat Junction in Haryana. Coming to the next tidbit. The Indian government is developing a policy to introduce ethanol as a mainstream clean cooking fuel to reduce the country's reliance on imported LPG. The plan could include dedicated spaces at fuel stations where consumers can purchase the fuel for specialized household stoves. Coming to the next tidbit. The Chinese AI company Moonshot, maker of the popular Kimi chatbot, is planning to go public in Hong Kong soon and could be valued at over $30 billion. This major move comes after the company reached $300 million in revenue following the launch of its newest AI model. Coming to the next tidbit. To reduce India's dependence on foreign GPS systems and protect critical infrastructure like digital banking, the government has launched a new network using White Rabbit technology to safely broadcast India's exact time across the country. Coming to the final tidbit. Apple has overtaken Nvidia to reclaim its spot as the world's most valuable company, driven by investor excitement over its upcoming AI-powered iPhones. That's all the news I have for you. Thank you so much for watching, and see you in the next one. Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.